Welcome to Lockbox, a podcast providing real estate professionals with action items for success. My name is Jeffrey Broger, and I'm going to be your host. I'm the founder of two real estate marketing and tech companies, STEEZY.Digital and RealNurture.io. In this podcast, you'll learn from top 1% real estate and mortgage brokers the exact secrets to their success. Welcome to Lockbox. Welcome to Lockbox. My name is Jeffrey Broger, and I'm here today with Peter Badger. Peter, thank you so much for being with us.
Jeffrey, pleasure to be here.
So why don't you start off by telling our listeners who you are and where you're from?
I am British, but lived in America the past 30 years. I spent 18 years on Wall Street. I drank the Kool-Aid from the early part of my career, worked from some amazing companies, finally exited out in 2008 in that great financial crisis period. Started my own tech startup in Silicon Valley, went through the full VC funding, exited in 2014 to Citrix Systems in Santa Clara. And really who I am today is I'm a full-time real estate and agriculture investor. And I coach people on how to keep and grow their wealth.
Awesome. Very intriguing background, especially when it comes to the transition from Wall Street finance to tech to now real estate and the choice to get into ag. Because the agriculture asset class is not talked about a lot. It's always, multifamily, syndications, this and that, right? And sometimes land and what else? The storage units, like the automated storage units and, seller leaseback. But these are the terms I hear at investor conferences. I don't hear a keynote talk about agriculture, right? So I would love to dive into that. Like, what attracted you to agriculture?
Yeah, I think the journey starts with conversations. So I exited my business in 2014. And, I was living in California, Silicon Valley. After California State Federal took 52% of my income, the question was, how do you take the final 48% and then, invest it wisely? Because I was on Wall Street. A large portion of my portfolio in the dot-com crash, global financial crisis, it's cyclical. So why spend all that effort in our lives building our own personal businesses as entrepreneurs and then not take the care at the end of that journey when you actually make some decent money to protect and grow your assets? So I was like, stood there, got a nice little nest egg, and I was with all my CXO friends in Silicon Valley. And I was like, listen, guys, mostly guys, sadly, what do you do with the money when you've made it? And I was given a resounding single statement, which is we make our money in public and private company stock. And then when you've made that money, diversify it into hard assets like real estate and farmland. And I was like, real estate's easy. We kind of know that. I had a few single family homes, started doing multifamily, ended up in syndications. I did short-term rentals. I looked at storage, did mobile home park. I went through every asset class possible. And then I found, this guy who was doing some advice for some of the richer Silicon Valley families. And he said, the thing most people don't know is that for high net worth individuals, the people that you and I are not, they often own between 14 and 22% of their wealth in agriculture or forestry products. And I was like, why? And they said, well, think about it from a real estate standpoint. Single family home, you've got stuff to maintain. You go up to multifamily because you got, expense scalability. You got one roof on 30 apartments versus 30 roofs on 30 houses. You go to a mobile home park, you've actually got no houses, no air conditioners, no tenants to trash it, no rehab costs. It's just a pad and some utility connections. It said once you get to the actual agriculture, you plant a tree, coconut, lime, lemon, avocado, mango, whatever it is. You wait 4 to 5 years for the crop to be produced, and then it produces crop for 40 to 60 years straight. And so they do it for two reasons. One is that it is inflation proof. Secondly, it's not correlated with anything else they have. And more importantly, it passes wealth through the generation. It's intergenerational wealth building. And that's when I got the bug for trying to work out how on earth you or I, Jeffrey, would actually get access to agriculture as an asset class.
Can I share a story with you?
Yeah.
So I had this really unique employment opportunity after my direct sales gig before starting my real estate marketing agency. It was a family referral to a redwood lumber manufacturer in Northern California.
Yeah.
When the recession hit in 2008, there were, I think, 40 mills up there. And when it hit, there were then two. All those two, Redwood Empire, which is where I worked, and Mendocino, bought up all the rest. And the edge that Redwood Empire had is that they were vertically integrated. They owned redwood forest land. They weren't just a mill. They weren't just a wholesaler to the retail outlets that we see, like J&W Lumber, Home Depot, Lowe's, right? There are steps in the supply chain above that, the wholesaler, the mill, right? All these different steps. They were vertically integrated, but at the very top is the first cut. And I learned that almost all the money is made on the first cut. Then it's 2%, 3%, and each step down, the rest of the funnel to the end consumer. And it's always, marked up along the way so those businesses can profit. But it's almost pure profit on the first cut because guess what? They own land where redwoods are growing in their natural environment with no help from water or, fertilizer or, getting rid of bugs and pests. They're growing in their natural environment, thriving, and they do 30-year or 40-year crop cycles. And, they'll do selective cutting. They'll cut the bigger ones and leave the rest and replant, and just goes on. Meanwhile, the land is massively appreciating, by the way, because it's in Northern California. So I just found that really interesting. And I actually have a unique background that kind of qualifies me to have this conversation, which is fascinating. It's all coming full circle.
Yeah, no, it's great. Let's take the example. I have a farm in Colombia, the country, and we have 60 hectares of teak, plantation teak. And so to your point, what are we doing with it? Well, we actually didn't know what to do with the teak when we bought the farm as a cattle farm. We've got coconuts behind me on this screen. That's where the teak is, by the way. We just happen to have 60 hectares of teak on our cattle farm that we replanted with coconut trees. So the question is, what do you do with it? Well, there was no way to send it. There's no sawmill. There's no way to process it. So we raised private equity, created a sawmill, and we found there was 10,000 hectares of teak in that region. Other cattle farmers who had this plantation teak that they couldn't do anything with. And so now we've built a sawmill, we process it, we cut it, and we're now going down to the finer layer, and we're building deck tiles, exporting them to America, and we're getting maximum profit for those teak trees.
At the hardwood retail outlets.
Opportunity everywhere. You just got to find it and find the right team who know how to extract and make the business model work.
Wow. Very, very interesting. So being an entrepreneur who has had various experiences, Wall Street, New York, finance, Silicon Valley, tech, successfully exiting, and then now being in real estate, diversification, investment, and taking that finance background into what you're doing today. I'm curious, what is the single most important action that you take on a daily basis, which attributes most to your success?
I think it's on a macro level. I realized in the past 30 years on this journey that you and I, entrepreneurs, business owners, senior A-types in corporate environments, we spend so much effort and time on building our businesses. We've got operations, process, tools. We work all the time on these things. And often what gets left behind is our own personal financial lives. And so I think the macro view of my life right now is I try and split my time between building my next business and taking care of my own wealth, my own finances. And I try and apply the same tools, process, data for my wealth building as I do for the core business I'm building as my primary passion. And I think that's where people lose out. They spend all this time building the wealth, but they don't take care of it. And I think I'm fortunate to be in that sunset of where I have some wealth now that I can take care of, and you can't ignore it. You've got to be the CFO of your own life. And that's my advice to your audience is, don't keep building new wealth. Make sure you're taking care of the existing wealth and retaining the capital and growing that capital along whatever journey you're on career-wise.
This is such a good topic that is not talked about enough, especially real estate professionals. I mean, talk about high income earners.
Yeah.
They're making multiple hundreds of thousands of dollars per year. Some of them are in the seven figures in commissions per year. And many, sadly, are being eaten alive by taxes because they haven't simply gone the extra step to work with a tax consultant that understands their business and the massive tax advantages that you receive as a real estate professional, especially if you own other real estate. Something simple like if you purchase a multifamily asset within the year, you can write off up to $60,000 of depreciation that year against your real estate income. Simple stuff like that, where you can proactively plan your income and portfolio to pay as little in taxes as possible. That's number one. I mean, Tony Robbins talks about it's not how much money you make, it's how much you can keep, right? And then number two, you mentioned that successful exit where, gosh, 52% was eaten alive by California state taxes and being able to then take that other 48% or, even on the exit, structure it properly to mitigate some of that loss. I mean, there are so many little steps along the way. And I feel like there's this sense of non-responsibility, I guess. I don't know how else to describe it. Aloofness, like this, I'll just make the money. I don't need to worry about, mastering all this. I'm not a CFO. I'm not a financial advisor. I think that's a mentality that gets people into trouble because when you just leave it up to others, no one's going to watch your estate more than you. No one's going to grow your money with more care than you. And something that I had to really understand in my early 20s was that it's my responsibility to become financially literate.
Yeah.
I then embarked on a multi-year journey consuming different books and starting new habits because I got out of college. I had paid for college myself. I had, direct sales ability where I could earn a lot of income, but I would always spend it before I got it. And every time I would make more money, my lifestyle would increase. And I had terrible habits. And I realized, my gosh, they don't teach this stuff in school, right? So I would love to just dive in deeper on that topic if you're open to it.
Yeah, no, and I think the funny thing, trust me, I'm not here saying people are doing it wrong because I did it wrong for 30 years. Can you imagine if I was in my 20s on Wall Street, taking those bonuses every year and put them into multifamily syndications or buying single family rentals? I mean,
my gosh,
it wouldn't have taken this long, would it? Now we know. So I think in reality, me and my friends, I'm 53 years old. All of my peer groups in their 50s now, we are starting to realize we've made mistakes in an earlier period where we're so focused on building our careers. And then you kind of like have this mindset shift whereby you're like, oh, wait a minute, we're coming to the end of that career period. I've got another 10, 15, 20 years of real grind and effort in me. Let's start to worry about what's going to happen after that. And that's really where my mindset went with the exit. It was the right time to step back. And so, Jeffrey, from my perspective, I've got a kind of a framework that I live by. And you need to have a framework. You've got to have a plan. Without a plan, you're not going to get anywhere, frankly, is my view.
Yes. And something that we talked about before the podcast was asset allocation. Now, this is something that it gets thrown around. And I believe the speaker who says it may or may not understand it, but the audience almost certainly doesn't actually understand. They just kind of nod along. Oh, yeah, right. Diversification, right? Asset allocation. These terms that aren't really defined well to the point where someone can actually implement it. So I'd love to spend a few minutes talking about asset allocation and how not having asset allocation is what gets people into trouble in downturns. And by having asset allocation, you're set up no matter where the market goes.
Yeah. So we need to kind of do a bit of a history lesson here. Because think about it. In one generation, from when I was in my 20s to now my early 50s, the entire picture has changed in the financial world. Because in the 90s, you could probably go down this Wall Street path, drink the Kool-Aid. Yeah, you put it all in the stock market. And you're 80% equities, 20% bonds. In your early years, you get towards retirement, you move towards fixed income bonds versus less equities. Now, the reality is that's okay because in the old days, bonds, 10-year treasury is like what, 1.5, 1.7% right now. You can't make money in fixed income anymore. Even corporate bonds, 2 to 4% on average. So the entire old school asset allocation where you move your money percentage-wise into different instruments in public markets over your lifetime, it's dead. You have to go elsewhere. You have to go to alternative assets. And that's why I'm in real assets. So to kind of give you the flavor of my rules in life, I have 3 pillars of where I put my wealth. Number 1, in the public markets. I still have between 10 and 30% in the stock market, depending on the market cycle. Right now, I'm at like 8%, just so you know, tells you where my head's at with the markets today. But the reason I do that is because I need liquidity. You can go in and sell your ETF, your mutual fund, your Tesla shares, whatever you're playing with. But at the end of the day, you don't control that money. Stock market's going to do what they're going to do. It's sentiment-based trading. Wall Street, wars, politics, news cycles, they're going to control what happens to that money. You have no control. But keep it in the markets because over a long term, you'll hopefully make money, beat inflation, but you have liquidity. I can get the money out if I need it in a rush. The mainstay, the second pillar of my wealth, is real assets. I've shifted it. I've managed to take the Silicon Valley money, the exit money, and I've now put it into real assets like multifamily real estate in the US, like agriculture overseas, non-dollar denominated. So I've diversified that platform. And to your point, Jeffrey, my goal is simple. During the good times, those real assets give me great cash flow. Occasionally you exit a property, take the appreciation, you're building your wealth. During the bad times, those assets retain my capital. I don't care during the next real estate crash if I don't get income for a year or two, as long as my principal has been retained during that down dip. And that's why you're in real assets. They're inflation proof. I can go on for hours about how you find the right real estate and or agricultural investments. But that's the key foundation of how I retain and grow my wealth during the up and down cycles economically overall. And so really important thing mindset wise, Jeffrey, I'd like to know how you feel about this from your perspective. My third pillar of wealth is 5 to 10% in play money, more risky stuff. So I'm into blockchain. I don't do NFTs. That's foolish. It's a hype cycle, but I'm in blockchain, a bit of AI. I have play money to keep me interested and more importantly, to distract me because I'm an A-type personality. I'm going to keep playing with my real assets if I'm not careful. So I distract myself with, let's call it the home run, let's ride blockchain to the moon type stuff, partly because it allows me to be intellectually stimulated while letting those real assets grow my wealth over the long term.
I like the play money concept and very well put, diversifying outside of just the traditional explanation of asset allocation being more tied to risk aversion in what you described, right? Earlier in your career, you can afford to lose it and you have a long time period. So you could be in equities and even if it goes down, you just hold it and it'll go up and you'll make more money over the long run. But as you get older, your risk aversion, it diminishes because now you can't afford those larger losses. You start to move it more towards the fixed income. That was the traditional, that was asset allocation back in the day, right? But nowadays, yes, the way that I understood it when I read the book Money from Tony Robbins, and he talked about Sir John Templeton, this world-renowned trader back in the day, kind of like even before Warren Buffett. He had this asset allocation formula, and he went through, security, growth, and then home run, having these different buckets. And you siphon off a portion of your income, or if you have a big windfall, you put a large portion of that into this, and then it's automatically split between these different buckets. And then as your risk aversion changes, you can go more towards security, more towards growth, but there's always this little home run bucket. And for me, being younger, I put a good amount in my home run bucket, my own startup, right? My own digital marketing agency that I'm growing and could sell one day for a huge profit, right? That's a home run, right? Pouring money into it, pouring time, pouring energy. And at the same time, I have the growth and the security already being taken care of. And when it's all growing, the way that I kind of reinvest things and get compound interest is they all feed each other. So the security gets a little bit when I have a big win, the growth gets a little bit, and the home run reinvests into itself. And then when we have those wins, there's also this dream bucket. And this is a concept that Tony Robbins talked about. He said, now you can go get that beach house, that, that car, go start a nonprofit that's this passion project or whatever you want to do. But as you're having these wins, if you're just siphoning off little bits and putting them into these little buckets, then it helps to not get you in trouble because, oh my gosh, here's this new tech startup that wowed me with a VC presentation. I'm going all in, right? You're not going to go do something foolish like that and potentially lose it all ever, but you can also still have fun with it. And nowadays, I did this in 2017. This was before, it wasn't before blockchain and crypto existed, but it was before it was popular and before I knew about it. So nowadays, I like what you're saying about even in the investing world, you can have, there's the high risk bucket. There's also this like play money, it's like, oh, I want to invest in this, invest in that, and see if I'm going to get 1,000% return, or it could fall to zero. So I think it's really smart to decide what that small amount of play money is and stick to it.
And you've got to be willing to lose it completely.
Yeah,
and
exactly.
One thing is like where we are right now in history is there's something called the financialization of everything. And this is where things are being tokenized and financialized to an nth degree. So the fact that you can go to Masterworks and invest in a fractional portion of a major art piece. We're doing the same thing in Farmland, by the way. We allow you to buy a portion of a farm, and over time, we're going to tokenize it, hopefully down to the tree. So you can put a dollar value in a set of different farms, different ages, different crops, and have that, bucket of diversification looking for. And so right now, there are so many of these things where every asset class and sub-asset class and sub-asset class is being tokenized, fractionalized, and financialized. So go and play. Find something you're interested in and, roll the dice a bit with that very small component and enjoy yourself because, you've got to be intellectually stimulated on this journey.
That's right. Absolutely. So where do you think the industry is heading? You mentioned there's a lot of things going on. There's, the cyclical aspect of the stock market. There's all the stuff that's happening in housing. I don't know if you had a crystal ball. You mentioned that you've kind of pulled back from stocks, which, I have too. We've seen how terrible of a year we've been off to. And now there's, war and all these things going on. It's like, okay, I'm just curious what your maybe 5-10 year projections are. What do you think's coming down the pipe?
It is impossible to predict.
Of course.
The speed of change and what's happening in the world is off the charts. I thought I'd seen everything. I'm 53. I was like, went through the internet, mobile, social, cloud.
Nothing else to invent. Yeah.
Exactly. Nothing else to invent. And then pandemic hits and geopolitical, it's just insane out there. So it's a very exciting time to build a business because there's so many tools and it's globalization has made it easier. You can hire anybody for any skill set, any part of the world at very low cost, and basically you can build anything you want. Technology has, changed our lives and the outlook for business building. But I think the funny thing for me is when I kind of like step back from it from a wealth standpoint, you may have heard of Maslow's hierarchy of needs.
Of course.
And so I kind of go back to the basics. Things don't change over thousands of years. At the bottom of Maslow's hierarchy of needs is food, shelter, security. As human beings, we need food to eat to survive. We need shelter, a roof over our heads, and security. And so I invest heavily now in agriculture and housing because I know it's never going to get, go out of fashion. That's the nature. And so why not back to basics, always stick to that? Because I've had, beach rentals in Disney, 75 million visitors a year going to Orlando, 19 theme parks. How can that go wrong? Pandemic, closed down, a year, no income. So you have these thesi about how these investments are fail-safe. And then an external shock happens, and you're like, what the hell just happened? So ultimately, food and shelter, standard multifamily housing in the US. Food is overseas agriculture, crops that are in demand all the time. Avocados, limes, coconuts, incredible hardy crop, avocados, and just stick to those crops that are going to be sold in supermarkets forever.
Love it. Yes. So Pete Middleton is in my network and he's a top broker in San Diego, a luxury specialist in La Jolla. And he was talking at a conference in October. The whole demeanor is just so matter of fact. He has so much conviction. And, there's all these real estate agents in the crowd wanting to learn from him. And he just says, look, we are a part of the base of Maslow's hierarchy of needs, right? Yeah. Food. And he said food, water, shelter. But he's like, food, water, shelter. We offer shelter, right? And I just, it struck me the way he said it. It's so true. I mean, what the industry that we are in, when you zoom out that far, is a mandatory need that everyone experiences on a daily basis. You go to sleep in it, you wake up in it, now you work from home in it, right? Real estate. And especially multifamily in the United States. My goodness, I'm a commercial broker in addition to having a marketing agency. I'm a commercial agent and I focus on multifamily. Huge tailwind that supports that is this underbuilding that has happened over the last 10 years, this massive housing shortage that we're experiencing in the United States, yet population has continued to go up. So yes, we are definitely in a place where that will be relevant for the foreseeable future, if not forever, right? The multifamily space. And the agriculture space is something that until this podcast, honestly, I had only been exposed to it with that Redwood Empire experience, but I never even thought of it for myself. So I'm curious about the ability and access of syndication and anything that you're putting together. You mentioned in the future being able to tokenize it down to the tree. But what's happening today? If I have $100,000 to deploy in the next 6 months, and I want to do $25K in a multifamily syndication, and then I'm looking for something else to do with the other 75, I might choose ag and start to explore that. But, how can I possibly own an entire farm in Colombia for 75 grand? Probably can't. So I'm curious if you are putting together syndications in the ag space and what that opportunity looks like.
Yeah. So we originally at Farmfolio, where I work right now, this is my next passion business, we're doing private equity syndications. We raised $5 million and planted this coconut farm behind me, 32,000 trees. It's producing now coconuts, we're selling them. It's an amazing private equity outcome. But what we realized also is that it's also very hard for the average person to get into agriculture. And so we've actually backed into a different model, which is Farmland Ownership, and it's titled Farmland Ownership. So now what we do is we buy farms, we break them up into individual lots or parcels. And so instead of having a single family rental that produces rental income with a property manager, you have 220 Tahiti lime trees producing limes that are being managed by the farm manager. And we basically have an offtake agreement to a pack house, which buys the limes from the tree. We then wash, sort, pack, export across to Philadelphia, East Coast, and across to Rotterdam in Europe. And they are sold in the major supermarkets like Trader Joe's, Costco, Walmart, Publix, etc. And so instead of rental income from a single family home, you're getting harvest income from your Tahiti lime trees. And we have this offering because it's very hard to get into agriculture. You either have to be accredited and find the right teams that have done a syndication deal, or it's agriculture is basically owned by large REITs, private family landowners, the rich and wealthy, or large conglomerates. And so we're kind of like down the path of democratizing farmland access so that people like you and me, Jeffrey, can actually get a piece of our own farm to receive that income. That's the journey I'm on right now.
That's why I love syndication. Yeah. It's almost the concept of balancing the scales, these accredited investor only, or these, you got to be wearing your big boy pants with a couple billion to be at the table to even see the deal. Those days are beginning to be over with the syndication model. And there are still things that happen that we never even see. People are in on different products that before they even reach the market and they make tons of money. And that'll always probably happen. But I love syndication because it makes a possibility for investing in something that you could never afford yourself a reality.
Yeah.
And you can also then get that type of security and returns on a fractional basis that these PE and these hedge funds that, they experience on a daily basis. So really love that. Very interesting. And I'm curious if I can ask you a tough question. And it's kind of a challenge that has become very apparent during COVID, and I'm super curious, but I want your permission because I don't want to put you on the spot.
That's all right. Go ahead.
Supply chain issues. What happens when I have a farm in Tahiti producing limes and there's no one unloading containers in the harbor, or there's all these supply chain issues happening right now?
I could go on for hours about the risks in every asset class. You've got to look at the risk side of it. I don't talk about these topics at a macro level because it's meaningless. And so you'll appreciate this, Jeffrey, because whenever you hear the headline, oh, US real estate is up by 3.7% in the past quarter, it's completely meaningless because real estate is local. It's down to the MSA, the block, the building, the asset type. It's the same in crops and the same in agriculture. It's the same in every single thing.
Sure.
So different crops behave different ways, different countries, different risks. And ultimately, supply chain is not a thing. You need to work out what your end-to-end supply chain looks like and plan for the unexpected. Now, the beautiful thing about agriculture is that most of the ports actually let perishables, fruit, vegetables, other agriculture in priority through the port processing. So again, you need to think about what's built into the supply chain. I lived in California for 15 years. I now live in Florida because they stole my money when my exit occurred with the taxation there. But ultimately, one of the reasons we've become East Coast US is because of all the labor and or port issues in California. I will not touch that market for supply chains. We design that in. By the way, 2/3 of the GDP of the US comes into the East Coast. It's an incredible market. Why not sell into that coast with our produce? And by the way, the ships can go either from the North Caribbean shore of Colombia, where a lot of our produce is created, and goes up to Philadelphia or up to Rotterdam in Europe to be sent across Europe. So the key is just designing in and making sure you're able to withstand shocks to supply chain, which people know about on a broader basis.
Wow. Very astute point. And the reality that perishables make it through makes complete sense. So thank you for fielding that question.
Now, right? Remember, was it last year when a ship got stuck in the Panama Canal? I mean, how ridiculous was that? By the way, we come out of the North Coast to avoid the Panama Canal. We did it originally to avoid the cost of paying to go through the Panama Canal. Ironically, when that event happened, none of our produce was impacted because we didn't have to go through. We came from the North Shore. So again, expect the unexpected. Sometimes you get lucky. Sometimes you're really good. You need both to be successful.
Yes, absolutely. Well, I really appreciate you fielding that question. Definitely was not one that I had prepared for, was scripted, but something I was super interested in because now that I'm, even for myself, considering personal investment, diversifying into ag, the first thing I thought of was supply chain. So phenomenal answer. Thank you. And, I'm very curious, as you have gone through this journey and, you've learned so many things along the way. In the last 5 years, what new belief, behavior, or habit has most improved your life?
I think my entire key is, so here's the weird thing. Our personalities, we are who we are. I've been a tech guy, I've been on Wall Street. I've been data-driven my entire career before it became the popular term. And I think for me, I have a saying, and we can apply it to all angles of life, by the way, it's trust but verify. So you can take it from, in a personal life standpoint or an investing life standpoint. You see a glossy marketing brochure recommended by somebody you really trust. And like most of us, in our real estate and our investing in life decisions, we trust other human beings on their opinion. And I've found in the past 5 years, as I've matured, I hope a little bit, I don't just trust, I trust but verify. And so if I am told something about something by a family friend for a personal life decision, I'll go deeper and really dig in to find out the truth underneath it, verify the data and or characteristics. From a glossy marketing brochure standpoint, trust your person who's recommending it, but ultimately go and find the underlying data and do the due diligence to make sure it's actually true. Because we are marketed to in all aspects of life. Yes. And the key of our behavior is to see through the marketing and get to the facts and the truth.
That's right. Wow. I love that. Headlines sell, but the meat is in the body copy, right? And
Yeah.
the fine print.
Yeah. If you remember, trust but verify, it's actually a Russian proverb. And
Is it?
it was done by Gorbachev and Ronald Reagan. And
I
Ronald
remember
Reagan,
Reagan is who gets credit for it in the US, but
yeah. And that was part of that whole series there was, we can trust, but we've got to verify. And
sure.
that's the case for decades.
Awesome. Hey, great principle. I love that. Is there a question that I should have asked you or anything that you'd like to expand upon from earlier?
I'd love to briefly mention risks and due diligence.
Let's do it.
Because people often say to me, well, how do I get into agriculture as an asset class? And I say to them, listen, it's like any asset class. You need to have your due diligence matrix and the stuff you tick off to verify. And so I tell people, you wouldn't buy a piece of real estate. Well, actually, many people do, but you shouldn't buy a piece of real estate if you don't know for that zip code and that block exactly what the demographics are, the average price of growth in condo or house values over 20 years, the declining crime rates, hopefully, the amount of jobs in a commutable distance. There's just data and characteristics you look for when you invest in a piece of real estate. And you have a corollary of that data and that due diligence in every major asset class out there, including ag. And so what I look for is the crop. You need to work out whether it's a hardy crop, the transport times, whether you can even import it into certain countries because they have phytosanitary licensing issues, where it's grown, is there strong multi-generational farming skills that know how to farm that crop in that region or location? Is it good weather, water, sunshine, soils? Has been ruined by the big ag corporations in the past. And there's just a whole set of major disasters. I don't invest, honestly, in farmland in the Caribbean because hurricanes sweep through every summertime. When Hurricane Maria hit Puerto Rico, 97% of their crops were completely wiped out. So don't invest in crops in the Caribbean. North of Latin America is there because the hurricanes come up, sweep by, and hit the East Coast. It doesn't touch Northern South America countries. Anyway, so really, when you decide to invest in things, look for that exact same set of data points or due diligence points, and really dig deep. And agriculture is like mobile home parks, like single-family home, multifamily, short-term rentals, storage, you name it. You need to have that due diligence matrix to not make mistakes, to get in with the right team, with the right track record, and trust but verify what they're telling you.
Great point. Just because this is something new that you've heard of now, and you know that the ultra wealthy have a large position of their portfolio in ag, that doesn't mean every single deal is the right deal for you in ag. That doesn't mean they're all safe and there's no risk and it's all reward. Still, the same principles apply. Do your due diligence, get with the right team. And with that being said, it seems like you're obviously an authority in this place and you have a team put together around this topic. So how can listeners contact you?
Yeah, so you can find us at farmfolio.net. Feel free to write to me directly, peter@farmfolio.net. I have my own personal risk matrix before I joined this company from my own ag investments, my own personal portfolio. And I'm happy to share that and give you a due diligence matrix that worked for me in the past 8 years to hopefully give you a leg up over most people. And like anything else, find mentors, courses. There aren't many. We've got some great ag investing guides, by the way, on our website. Just pull it down. Look at our 22-page agricultural investment guide and see what you need to worry about if you get into this asset class. It's all about education, to your point, Jeffrey. So peter@farmfolio.net. Drop me a note. Happy to talk anything, including asset allocation and the death of the 60/40 public stock bond portfolio.
Peter Badger, everyone. Farmfolio.net. Check him out. Contact him if you're interested. Really fascinating finance, tech, and background, and then going into real estate and agriculture. Really appreciate having you on. A very different angle and perspective on real estate than I usually have a conversation about. And I know that this brought value to my listeners because of that. So really appreciate having you on. Thank you.
Well, thank you for doing what you do, Jeffrey. And all your listeners, become the CFO of your own life. Don't just build the wealth, manage it, retain and grow it.
Thank you for listening. If If you want to accomplish your real estate goals, then I highly suggest downloading my free Ultimate Real Estate Goal Setting Framework. The link is in the description of the show, and it will help you break down your annual income goal into the amount of phone calls, appointments, or open houses you need in order to achieve that goal. Thank you so much, and we'll see you next time.